Hello and welcome to this Forex Preview at xm.com. I'm Maria Pachardis, and joining me is investment analyst Cristina Parthenido. We'll be discussing the upcoming data out of the UK and the potential reaction in the pound. So Cristina, there's a great deal of interest in how the post-lockdown economic recovery is progressing in the UK and how that could play out for the Bank of England, which is meeting next week, taking into account, of course, that the Delta variant is still driving the third wave of infections. Encouragingly, though, today's employment data showed the payroll employment grew just above last year's pre-lockdown levels in the 3 months to August. But we still have CPI inflation and retail sales data on the calendar on Wednesday and Friday. How might this data contribute to the Bank of England's policy outlook?
Hi, Maria. Indeed, today's employment data are an encouraging sign that the UK economy is moving to the right direction, facing continuous recovery despite the falling wage subsidies from the government, which are entering their final weeks this month. Of course, it's still uncertain whether businesses will be able to cover the full employment cost once these subsidies expire this month, or alternatively cut the number of employees, causing a pickup in the unemployment rate. But so far, the data look promising. Apparently, more is needed to be done because despite the employment growth, there are more than 1 million positions opened, according to the stats, which reflects that labor supply is still a problem and perhaps is one of the reasons why production is too slow and therefore prices are high. The Bank of England continues to believe that high inflation is temporary, but we don't see any convincing slowdown in inflation yet. Tomorrow, the headline CPI is expected to move beyond the 2% target to peak at 2.9% year on year. And probably this may create some anxiety within the central bank. But the Bank of England has already introduced its policy guidance saying that it will stop reinvesting its government and corporate bonds once interest rates rise to 0.5%. And then if economic conditions allow for more rate hikes to 1%, it will even consider selling its bonds. Current expectations are for a 15 basis point rate hike around May 2022. So a stronger inflation print tomorrow could raise the odds for a rate hike in May, especially if retail sales on Friday also show that stronger consumer spending is also motivating higher prices. At this point, I would also like to add that during the previous policy meeting, the central bank's committee was evenly split between those who believe that the economy has met the minimum criteria for a tighter monetary policy and those who believe that more is needed to be done to start reducing stimulus. But next week, we will have an extra person to vote, and that is the new chief economist, who is considered a hawkish policymaker. So if this week's data are strong enough to persuade him to express his hawkish thoughts, that could make a rate hike in the second quarter of 2022 more likely.
Right. Okay. Now, the upbeat employment data helped the pound to pick up some steam today. Do you think the rally could further stretch into the week?
Well, as we said before, that may depend on whether the data will be strong enough to increase hawkish calls for stimulus reduction at the next week's policy meeting. If they manage to do so, I expect the rally to break above the 1.39 level against the US dollar, which has been a big struggle for pound dollar since the start of August. Then the next obstacle could be somewhere between 1.3982 and 1.40. But in order to reach that area, the Bank of England needs to appear quite hawkish and say something big about its plans to reduce stimulus next week.
Cristina, thanks so much. And thanks for joining us at xm.com.